Hi everyone, and welcome to another live event with Financial Juice. We've just had the ISM numbers come out at 55.7 versus an expected 54.0. And today's event is going to start off with the ISM numbers, and then we're going to just basically go into a general discussion of market economics and anything else that comes up. So my name's Amar, and I'm the guy with the huge headphones that should be coordinating air traffic right now. Joining me today, we've got Adam Button from ForexLive, Jason Sen from daytradeideas.co.uk, and Steve W from No Brainer Trades and FXS Analytics. Let's get this rolling. So, just before we get started, a little bit of housekeeping. I'm just going to share my screen with everyone, and you should see that now. Okay, if you're watching the event today, you should be able to see it directly on the site by clicking this link here. So you can keep an eye on the news and whatever's happening in the market. But also, if you choose to do so, you can join the conversation, which would be really great. If you've got any questions that you want to ask any of the guys, you can join this section of the site, and you'll be able to watch the event playing live, and you'll also be able to reply to any comments or questions or anything, which I encourage everyone to do because it just makes the event that much more interesting. So we've had a pretty good number come in, and at this point, I'm gonna hand things over to Adam Button for the first opinion on everything.
Yeah, I mean, it's great to see these numbers out. It's a bit of a surprisingly strong number, but nothing outside of the ordinary. 1.7 points higher, or 1.3 points higher than we were looking for on the consensus. A lot of U.S. dollar strength right off the hop. Highs of the day in dollar yen, lows in euro dollar. So what I find interesting about it is the new orders number. It's extremely strong. It's 63.2. It was expected at 58.3. That really flies in the face of what we had last week with durable goods orders, and generally those should jive a little bit. And durable goods orders absolutely collapsed last month, and here we have a very strong sign of new orders in the manufacturing sector, and so there's either some sort of seasonal adjustment problem where we see, there's a lot of talk about at the start of the quarter that we had these problems with durable goods orders, and we really have no idea where manufacturing is. And if we look back at the trend in these numbers, this is the overall index is at the highest since 2010, or right at the end of 2011. Or pardon me, right at the beginning of 2011, but just a few months ago we were at the lowest since 2009. So there's no great sense of where the trend is in U.S. manufacturing, and indeed where the trend is in the economy. So it adds to the cloudy picture that the Fed's looking for, or the Fed's trying to look through. And at this point, we're fairly convinced that the Fed wants to taper, and when it sees numbers like this, it makes it easier for them, and that's why we're seeing so much U.S. dollar strength at the moment.
That's great stuff, Adam. So, do you think we're going to be seeing the Sept taper that everyone's been talking about, or are we likely to defer it for a little while longer?
Yeah, the Sept taper. That's I think that's on. It's happening, and the reason isn't so much the data. You can spin the data any way you'd like at this point. And it's certainly stable. It's not accelerating. Third quarter growth isn't going to be spectacular. And there's, unless Congress sorts out the debt ceiling and everything else, there's no indication that we're in some sort of rapid pickup that necessitates some urgent action. But the Fed's concerned about financial risks from holding such large bond portfolio, not so much inflation. And they're working to normalize as quickly as possible, and I think they want to send a message with a $10 or $15 billion taper, and I'm very confident that it's coming on September 18th.
When we've had talk of the taper, the market's taken it very negatively, understandably. Do you think with the kind of rhetoric that we've been seeing these last few months, that when the taper actually takes place, that the response will be quite muted?
Yeah. I mean, you have it. It's a good point. It's we talk about the market. There's some different markets, and I don't really think the stock market gets it. You see the bond market selling off hard here. Stocks are rallying this time, But at times you'll see good news and the stock market will slump. I mean, we saw it last week, just kicking and screaming because of the taper. But the market's slowly keying in, and the taper's coming on, mostly on better news, and that, so there isn't that much of a risk, I don't think, of itself, as long as the Fed can spin it that it isn't about financial risk. If the Fed were to come out and say, this is a problem, we don't want to expand our balance sheet any longer, or we want to slow the pace of it because we're worried about holding too many assets, then you're going to see markets really start to kick and scream. But at this point, the market's willing to believe the illusion that the Fed's going to be right about growth forecasts this time, because the Fed's been wrong so many times about predicting 3% growth this year. Well, we're going to be lucky to get 2% growth this year. So, it's once again what it is. But stocks up 1% today, and they don't seem to be too worried about any sort of good news today. Even though obviously we don't see a rally in stocks on this, we just sort of smooth right through it.
Excellent, buddy. Well, appreciate your thoughts. Steve, we'll hand over to you now for your view on the numbers and overall.
I'm just sort of hanging in there in terms of the market reaction. When you get usually a better than expected number like this, you don't see too much in terms of immediate follow through. It just sort of whipsaws, and we're actually coming down, especially on euro right now, on some pretty key levels. We've been sort of playing the rate game for the last few months here, so we've just basically been in a trading range, large trading range. We're in downward channels on, or upward channels on the dollar index, and so I'm just been sort of waiting for any like major cues in terms of any kind of directional shift right now, but it's not coming. And so yeah, I mean, like Adam was saying just about the tapering, we're really not going to hear much in the way of that probably for another few weeks. So for the time being, it's sort of been back and forth, back and forth. Came off these highs on euro, but I'm definitely not one of the believers that this is just going to fall off the map right now, especially after numbers like this. When it's a bad number for the U.S., you usually get a much harsher reaction on this. But for today, we're definitely not seeing that. So.
Okay, so yes. With the view that the taper is much more likely to happen, this is just another number that coincides with that as a general direction for the Fed's policy. How do you think the dollar will react in future towards the taper and towards what's happening right now? We've seen past reactions. Do you think Adam and I were discussing a more muted reaction as a result of all the buy the rumor, sell the news type of deal? Do you think that we're going to be seeing a similar type of reaction to the taper in the currency side of things?
It's already underway, and so we're not going to be able to play catch up once that time comes around. It's just if whether or not it gets realized or not, then we'll see the reaction. But of course, ever since ECB kind of mimicked what the Fed was saying in terms of just holding off on rates and whatnot, not the tapering obviously, but that's when we really started sort of playing the fiddle up and down here. But yeah, I mean the move has already been underway. So it's pretty much the second you hear about it, any of those rumors, you're basically jumping on the boat as soon as you possibly can, playing into the actual day itself. Expectation, reality. So
yeah. It's just one of those things.
What we're looking for too is going to be clues on what happens next. So if we take off 15 on the taper, okay, how quickly do we want to do this? Will the Fed move again in October? Well, that seems unlikely at this point. Is it off to December? Okay, then what? Then in December another 15 billion. How quickly do we want to taper back, and how aggressive a signal will they send? And that probably at the end of the day will be the bigger reaction, but. Like Steve mentioned, there's a lot of fish to fry in the market in the next 16 days before the Fed decision. I mean, throughout this week, big economic data. Watching the euro right now, as you mentioned, big levels. It's just came right off the 200-day moving average, 5 days in a row down in the euro. So, there's certainly a case to be made for a bit of a bounce here, and the dollar certainly isn't following through very aggressively on any sort of rally. So it's going to be a great market in September. It's been a bit of a choppy market all summer. But we're looking for some trends here. They're just going to pick up and go.
Yeah, it's just chop, chop, chop. It's been this actual area. You were just talking about EURUSD. You got me thinking here, but this area in general has been a pretty key area, right ahead of that 3100 handle, which is probably the most important meter at this point in terms of where we go from here. So, it should be interesting. There's a lot of protection ahead of that level, I know, and as I'm watching price right now, it's kind of interesting to see just this is what we talk about. And you say just a positive number for the U.S. and just the markets shrug it off all the time, especially this one. If it's bad, it's another story. So that's why we're just sort of.
Absolutely. Before we bring Jason in, I just want to mention to anyone that's listening in, if you go to the discussion page, which if you're on the front page of the site, you'll see a link to that at the top. You can join in the conversation. If you've got any questions, points that you want to make, points that you want to add to the debate, feel free to do so. It will update in real time, so we'll be able to see any of your points. Just now, there's a comment from someone that's calling themselves Ziki. ISM now mostly meaningless, as manufacturing just-in-time orders, etc., are now high frequency. So you feel free to join in the debate. We'll be able to share your comments and share your points of view. This is kind of like an interactive CNBC. So feel free to join in with us. So at this point, Jason, I'd like to bring you in for the technical take on things.
Hi there. Technical take. Okay, well, I have to agree with the other guys. I mean, it is choppy. Trying to find a trend to jump on these days isn't that easy. Stock markets are obviously generally in nice uptrends. They do differ but the US, S&Ps and Dow Jones are in nice uptrends, and we've seen what I think is just a healthy correction. I had 1630 for a target on the S&P, and it's hit that, dipped a little bit below that, but we've recovered now and sitting above the 100-day moving average. So I think the stock markets are fairly safe at the moment. Might push a little bit higher into the autumn, but we've got to be a bit careful because there's some slightly worrying patterns, but we'll deal with that at another time. But over the next couple of weeks, I think we look fairly safe as long as some war doesn't break out somewhere. What can I say? Yeah. I mean, the currencies are tricky. I was just having a look at the euro and cable, and they hit the upper end of their recent ranges. When I say recent, we're going back at least 6 months, and they're just range bound. So we've hit the upper ends of the ranges. They're pulling back. We're sort of heading towards the middle of those ranges. All you can do is really trade those ranges until we see some sort of break, really. But I'm not seeing anything that's going to get me excited about any particular new trend.
Okay, you mentioned some technical patterns that you're seeing. Do you think the fundamentals of the market are in line with some of the patterns that are emerging? And does that kind of add fuel to the fire, or because obviously any trade works best when you've got the fundamental and the technical view of the markets kind of aligned. Are you seeing that kind of correlation there, or is there a bit of disjointment?
It's a good question. I try not to focus too much on fundamentals. I mean, this stock market rally's caught me out. I'd never expected it to go this far, to be honest. Yeah. I guess when the Fed's throwing money at everyone and forcing people to buy stocks, this is what happens. So, of course, I suppose this is also why there's so much focus on the taper. I'm slightly concerned that we will build a more negative pattern, but and what happens there? I mean, I'm certainly not getting anything like bearish at the moment. I know that we've had a recent sell-off, and suddenly everything I was reading was, oh my God, the world's over. It's all bearish. But that always happens as soon as we get a couple of weeks of a sell-off. I don't feel like that at all. I think if anything, we're going to push high and retest recent highs. Yeah, that's really all I guess I can say as far as stock markets go. We'll just have to see how they develop over the autumn. But at the moment, there's no sign of some big autumn crash like I've been reading in some of the press.
Okay, guys, great stuff. Let's make things a little bit more conversational with a back and forth. The question I want to put to you guys is, obviously there's a lot of talk about a Sept taper. That's one of the big things that's being thrown around at the moment. But if that does indeed take place, what's next for the markets? We're talking kind of medium, long term, the next 6 months, the next year or so. How do you see things panning out, and what do you think, the direction of the overall fundamentals? What I've noticed myself with the stock market is, generally speaking, the numbers and earnings haven't been particularly great, but we just seem to keep making new highs. Do you think that overall trend is likely to continue? And just a general view of the market over the next 6 months or so. Adam, should we kick off with you?
Yeah, I mean, if we want to look at the whole market, the stock market, for me, isn't in that bad of a spot. The multiples aren't so bad, and the trend has been higher. And we've seen, if we go back 15 years, you really don't have a market that just busts on soft growth, soft-ish growth.
Mm-hmm.
Sure, you can have a 5-10% correction. That'd be nice. I think a lot of people would like to see this stretch back just a little bit farther, and maybe we'll get that before the taper. But anything beyond that is outside of a crisis, outside of a dot-com bust or housing completely collapsing. You just don't see big sell-offs in the market. There's just this underlying confident trend in stocks, and is the Fed sort of tapering really changing that? People talk about it like it's the first step of tightening, or it's like the first. They compare it historically to the Fed raising rates. Well, it's not really raising rates. They're just slowing the purchase or the path of purchases. So when we get to raising rates, maybe it'll be a little bit of a different conversation. But there's no signs of inflation. The growth picture isn't materially changing. So if you're a stockholder, you don't see a material change unless you're expecting some sort of acceleration into 3 or 4% growth. But companies have shown they can earn money in a poor environment. The growth has been 2% now since the crisis, and it probably will continue to be 2%. I mean, the new normal is here, but companies are finding a way to make money, whether it be abroad or whether it be through whatever regulation, government breaks and whatnot. So, to see that ending, and that is the big trend, is hard to believe. But how much higher can you really go? That's certainly up for debate. But could 2014 be another year? Could the rest of the year be good? Yeah, I mean, and the money is going to come in if we get a significant sell-off, and then I'll just pass it off to you guys and sort of see what you think.
For me, it's always a comparative game. So we had our bump higher, and then I'm using Euro USD. I'm an FX guy, so pretty much a lot of what I do from a macro perspective is looking at rates in just comparing central bank policies and seeing how that basically translates into the value of all these pairs. So for me, it's been a situation of just basically following the cues. The ECB came in, and that's when we got our top in Euro USD. Tapering language came off. We have more downward fall to go, basically. So and none of these guys really like to move on their own anymore. I mean, we learned that the hard way back in 2008 or 09. So they do like to basically stay somewhat in sync with one another in terms of volatility. So but yeah, I mean, it's again, for me, it's everything's comparative in nature, and so for me, I like to keep it simple. I don't really see it as anything more than just basically wait until the next round of language comes in and hop on it. I really don't get too complex with this stuff because nobody knows what they're going to do and what the effect, the end effect of it's going to be. Basically, everybody's just trading feelings anyway. So all you can really do is just keep your ears to the wires and react accordingly. So.
Absolutely. I've just got a couple of comments that have come in on the chat. This is something that I mentioned briefly before, but we can go into a little more detail. Yohei is asking, with the FOMC decision scheduled just 4 days before the elections in Germany, can we expect a somewhat limited reaction to the decision in Euro USD?
Yeah, that's a great point to consider. I mean, there's about 4 days in between, and sometimes that can be a lot of time in the market. So, the taper is the bigger story, and at that point, we might have a better idea on what's going to happen in Germany, the outcome of the election, and I think Merkel's in a fairly comfortable spot. But I mean, elections have proven time and time again over the last few years you can't take anything for granted. If the dollar is going to rise broadly, it will happen against the euro as well. So, I see those being two different events for the most part. But it's one of those months where every day. I mean, today it's ISM, tomorrow it's something else, and tomorrow you have ADP numbers, and then ISM ISM services data on Thursday, and then non-farm payrolls Friday, and every one's a different story, along with everything else that's happening in the world. So, I'm not really sure which way to go on that. I think the market will probably, after the knee-jerk to tapering, start to look at that election in Germany a little bit more closely.
Steve, you want to chime in on that one, or shall we move on to the next question?
I mean, I really don't have much to say about that. And I mean, a lot of the topics that we're covering too, it's just I am a day trader, and I'm very technical in nature. Anybody that knows my blog, so again, I look at sort of the macro perspective very broadly, just in terms of how people are going to react to it, and just as long as you have a gauge on that behavior, I guess is the key. As far as that is concerned.
Okay.
I mean, as far as the limited reaction goes, I really don't know what kind of impact that election is going to have. I mean, elections in general, sometimes they can have a more severe reaction, but many times they don't. And so I'm kind of on the fence about that. And obviously, FOMC is another story, but.
That's a great point about elections, Steve. You say, I mean, they're so built up so often, and the CNBC and the minds there, they just love to talk election, and then
happens when
yeah.
I mean, it's kind of a non-event a lot of times. I mean, it's a huge event, but as far as the market's concerned, you don't really see too much. From what I've seen, in my opinion. So I don't know.
Okay,
you can start trading. You can start trading on election rhetoric. I mean, I've never heard of anyone making any kind of money on that, because you don't believe. I mean, nobody in the market believes anything that anyone's promising. So it's just noise, and you see the headlines coming out of Germany now. They're promising not to do this and that. I mean, no one cares.
Okay, another comment by Ziki. This is an interesting one in my opinion. Seems to me that the US and Euro equity markets are now totally detached from the consumer realities. UE is high, USA job recovery is 77% part-time, temporary low wage, no benefits. So isn't the market's behavior simply a function of excess liquidity? I think Steve touched on this earlier on as well. Or was it Jason?
I think I did a bit, yeah.
Yeah.
Yeah, I mean, I do agree with that. I mean, I know valuations, as Adam said, they're not overstretched, so that's fair enough. But we've had a heck of a run. We're around new highs. I'm sure it must be something to do with liquidity. My worry is now that we just go sideways, volumes drop off even further, and we just trade a wide range for the next few months, which I don't think would be great for anyone really. It all depends on when they taper and how much, I suppose, but that's my biggest fear, I think.
Adam, any opinions?
I mean, I mean, you hear this all the time, right? I mean, the economy isn't as strong. Well, it is. It is what it is. It's 2% growth economy. There are no jobs. There aren't going to be any jobs. And I think it's not that we don't know that. It's the market is priced it in. Yeah, the companies are still paying 3% dividends or 2.5% dividends, and you deal with it. And like I said, where else do you put your money? We talk about rates, or Steve was talking about rates. When 10-year yields get over 3%, that's going to be maybe a break point where you get that sort of correction. We're at 2.89 today, up 11 basis points. So a bit of a race towards 3% today. That could be an interesting inflection point. And there are going to be some really significant fallout effects from the bond bubble reversing. I mean, it's a 30-year trend of lower yields, and it's over. You know, we can go sideways for a number of years, and that's probably what will happen. But you know, getting up over 3 or 3.5%, it might change the picture a little bit, and it changes the FX picture as well, with US becoming so much more attractive compared to somewhere like Germany or Japan. So you know, that's part of the equation. If the Fed's tapering as well, then you get, you know, leveraged people dumping bonds into it, and it can skew it and add volatility, and at some point bond funds just begin to change everything. So you know, that's where you have to keep one eye on at the moment.
Okay, everyone's waiting for me. Okay. I thought there'd be some big conversation with everyone chiming in, but okay, guys, really appreciate your time today, Adam. Those were some great opinions. If you've enjoyed today's event, feel free to send us your feedback to support@financialjuice.com. We're still experimenting. We're trying a lot of new ideas out, trying to change the way things are done in terms of this type of content. So I'd really appreciate your opinion. Feel free to let us know on the website or by sending us an email, and we're going to continue to try some different formats and different ideas and see what really works and gives you guys, you know, the best content in the best possible format. So gentlemen, I really appreciate your time today, and just, you know, give you a second to say goodbye. So this is Adam Button from ForexLive. You can definitely get in touch with him on Twitter, which is @ForexLive, and definitely have a look at ForexLive.com, which is one of the best blogs in the Forex space. Jason Sen, if I can get Jason up. Jason Sen,
Yeah.
daytradeideas.co.uk, provides some really good technical information, so definitely worth checking him out. You can get a hold of him on Twitter at, what was it, Daytrade Signals?
Daytradeideas.com.
Daytradeideas.com, but what's your Twitter handle?
Oh, my Twitter handle, sorry, it's Daytrade Signals, you're right.
Daytrade Signals, okay. Excellent. And we have the one and only Steve W. And you can see his details on the screen. So at No Brainer Trades, nobrainertrades.com, and his YouTube is No Brainer Trades. So by all means, do check his information out. It's very, very good. Thanks a lot, guys. Appreciate your time very much today, and we'll have a recording out for everyone very soon. Cheers.
Thank you.
Great talking with you guys.